Half the people who won't buy insurance aren't rejecting the product. They're rejecting you, the insurer. That's not an opinion. That's what the data says. And in the next 8 minutes, I'm going to walk you through 2 consumer perception surveys, tell you exactly what they mean, and give you a concrete plan for where the industry needs to redirect its money, its people, and its messaging. Starting now. Every year, industry reports repeat the same line. Insurance penetration in emerging markets remains low. Kenya, Nigeria, much of sub-Saharan Africa and South Asia. And every year, the default explanation is the same. People are poor, insurance is expensive, end of story. That explanation is comfortable. It's also, as we're about to see, largely wrong. 2 recent consumer polls, one run by Insurance World TV, one an independent LinkedIn survey on buying behavior, asked people directly why they don't engage with insurance until it's too late. The answers should be required reading in every underwriting department, every product committee, and every marketing budget meeting in the industry. Let's get into the numbers. The data. Survey 1 asked, when do people seriously consider buying insurance? 56% said, only after a loss or an emergency. 33% said, only when a law or a lender forces them to. Just 6% said they buy before anything goes wrong. And only 6% said a professional's advice was what moved them. Add that up. 89% of buying decisions are triggered by something external, a disaster or an obligation. Only a tiny fraction reflects genuine forward planning or trust in professional guidance. Survey 2 goes further and asks why. It asked, what's the biggest barrier to insurance uptake? 50% said, lack of trust in insurers. 30% said, low public awareness. Only 10% said affordability. And 10% said they simply don't believe anything bad will happen to them. Sit with that for a second. Affordability, the excuse the industry leans on most, ranks dead last, tied with pure fatalism. Trust outranks it 5-1. And this pairs directly with a separate finding from the same research house. Only 40% of consumers would buy after a loss, and a mere 15% see insurance as part of long-term financial planning at all. Put these together and a single, uncomfortable pattern emerges. This is not a pricing problem. It's a credibility problem. What this actually means. Here's the interpretation, and I want to be blunt about it. For decades, the industry's default response to low penetration has been to build cheaper products. Microinsurance, stripped-down policies, flexible premiums. Worthwhile work. But if only 10% of people cite cost as the barrier, cheaper products are solving a problem that isn't the main one. Meanwhile, trust, the actual number 1 barrier at 50%, usually gets a marketing response. Brand campaigns, slogans, sponsorships. But trust deficits aren't solved by better slogans. They're solved by better experiences, specifically at the 2 moments that shape a customer's entire relationship with an insurer: the sales conversation and the claim. Ask yourself why 56% of people only buy after a loss. It's not because they don't understand risk exists. Humans understand risk intuitively. They buy insurance for their phones the day they crack a screen. It's because they don't believe the insurer will actually pay out when it matters. That belief isn't irrational. It's shaped by real stories. Friends whose claims were delayed, denied on a technicality, or dragged through months of paperwork. Every bad claim story an insurer generates becomes free, negative advertising that reaches far more people than any ad campaign the insurer buys to counter it. And the 30% who cite low awareness aren't confused about what insurance is. They're unclear on what it does for them, specifically, what it would have covered in the last crisis they lived through. That's not an awareness gap in the abstract sense, it's a relevance gap. So the 2 real problems the industry needs to solve are, prove you pay claims fairly and fast, and make the value of coverage concrete and personal before disaster strikes, not reactively, after it.
So, where should the industry reorient resources?
This is the part that matters. Not just what's wrong, but what to actually do about it. 5 shifts in priority order. 1. Move budget from acquisition marketing to claims experience. If trust is the #1 barrier, the claims process is your marketing department now. Faster claims turnaround, transparent status tracking, and proactively publishing average payout times and approval rates will do more for uptake than any billboard. 2. Build trust infrastructure before you need it, not during a crisis. Publish real claims data, third-party audited payout ratios, customer claim stories told honestly, including the ones that were denied and why. Radical transparency is a competitive advantage precisely because so few insurers are doing it. 3. Shift distribution toward trusted intermediaries. Remember, only 6% bought because of professional advice. That's not because advisors don't matter. It's because too few consumers are actually getting independent advice. Invest in advisor networks, community-based agents, and employer-embedded insurance where a trusted third party, not the insurer directly, is making the introduction. 4. Reframe messaging around relevance, not risk in the abstract. Stop selling protection as a concept. Start showing, concretely, here's what this policy would have paid out in the flood last year. Or, here's what this covered for someone exactly like you. Specific, local, recent. That's what closes the awareness relevance gap. 5. For regulators and policymakers, this data is your evidence base too. If uptake is trust-constrained rather than price-constrained, the highest leverage regulatory tool isn't further premium subsidy, it's stronger claims conduct enforcement and mandatory public disclosure of payout data. That's where regulation can move the trust needle at a market-wide level. The industry has spent years assuming the barrier was affordability. The data says otherwise. The barrier is trust, and trust is earned in exactly 2 places: the sales conversation and the claim. Get those right, and penetration doesn't need a subsidy. It needs proof. If you found this useful, subscribe to Insurance World TV for more data-led breakdowns of what's actually happening in the insurance market, not just what the industry assumes. See you in the next one.
Insurance awareness changes lives.
Education creates empowerment.
And empowerment
Create